Thank you for watching module number 6. In the previous module, we talked about how income-driven repayment plans work. We want to take a look now at pay-as-you-earn, known as PAYE, versus revised pay-as-you-earn, known as REPAYE. We hope that this will help you make a decision about which of these will be best for you if, in fact, you need to use an income-driven repayment plan. Now, this is a comparison chart of some of the most important characteristics of pay and repay. We haven't listed all the differences here, but these are differences that we think are going to be important to you as you make your decision between pay and repay. Let's start with payment calculation. The payments are calculated exactly the same way in pay and repay, 10% of something called discretionary income. But notice with repay, there's never a payment cap. It's always 10% of discretionary income. With pay as you earn, you are never going to be kicked out of pay as you earn, regardless of how high your salary gets. But at some point, if the calculation, 10% of discretionary income with pay as you earn, is higher than what you would have paid under the original standard 10-year plan, your payment in pay as you earn is simply capped, or it maxes out at that original standard 10-year amount. Once again, you're never kicked out of pay, but your payment would be capped at that original standard 10-year amount if 10% of your discretionary income is higher than that. That's a nice provision in pay for borrowers who anticipate a salary increase at some point that's going to be significantly higher than their outstanding debt. The repayment term is 20 years with pay. It's 20 years with repay if all the borrowing is from college. It's 25 years for those of you with graduate school borrowing. And once again, at the end of the repayment term, if you've not retired the debt under either plan, the debt is forgiven, but is considered taxable income the year it is forgiven. We mentioned this on an earlier slide. Spousal income is always counted if you're married filing jointly. That's always counted under either pay or repay. You can exclude spousal income from the calculation of payments with pay as you earn, but you have to file a separate tax return. Now, in terms of the subsidy on subsidized loans, remember subsidized loans are only for college students. With both pay and repay, the government will pick up the difference, 100% of the difference, anytime the interest you owe on those loans is higher than the calculated payment. With pay as you earn, there's a limit to 3 years where the government will do that. With repay, it's a bit more complicated. They will give you a 100% subsidy. Once again, they'll make up the difference between the interest you owe and your payment. If the interest is higher than the calculated payment, they'll limit that to 3 years, but then after 3 years, they will do a subsidy of 50%. So that's the subsidy on subsidized loans. Now, graduate and professional students pay special attention to the last item here. The subsidy on unsubsidized loans. We're talking about unsubsidized direct loans and also Grad Plus. The government will subsidize 50% of the difference anytime the interest you owe on those unsubsidized loans exceeds the calculated repay amount. For undergraduates, if you have unsubsidized loans, this works as well. But graduate students tend to be very interested in this provision because of some of the high debt levels of graduate students. So these are some of the differences between pay and repay. So the question then comes up, which is going to be the best plan? Now, please note these are guidelines. You need to make your own decision in terms of which is going to be the best plan for you. But pay as you earn may be best for a borrower who expects their salary to exceed their debt pretty dramatically at some point pretty quickly after graduation. In other words, they're very interested in the payment cap that pay provides. Remember, the payments are capped at the original standard 10-year amount. Pay is also going to be best for borrowers who need to exclude spousal income from the calculation of the monthly payment. The only way to exclude spousal income, as we said, is to file a separate return and use pay-as-you-earn. REPAYE may be best for borrowers who have a large gap between their debt and their income and anticipate the gap being large for a long period of time, because the subsidy, the 50% subsidy where the government slows down how fast your debt grows, is something that will really help. And this is one reason REPAYE is popular with highly indebted graduate students if you happen to have a relatively low income for an extended period of time. REPAYE may also be best for someone who is single and just doesn't have to be concerned about spousal income, or whose spouse has relatively low income. So those are some guidelines in terms of who PAYE and REPAYE may be best for. Now, both PAYE and REPAYE are good plans, and you can switch plans. You could, for example, start with REPAYE. Maybe you're a graduate professional student, you have a lot of direct unsubsidized and Grad Plus, and maybe the gap is really high between your debt and your income, and you're interested in that 50% subsidy that we referenced earlier. You could start in REPAYE, and then if you got married and the inclusion of your spouse's income was causing your payment to go higher than you wanted it to, then you could consider moving to PAYE. Remember, you'd have to file a separate tax return at that point to exclude spousal income. So they're both good plans, and you can switch plans. We'd encourage you to go through the chart, look at the differences in the programs, and see which one suits you the best. Do not let your loan servicer select the plan for you. We mentioned that there's a place where you can do that on the income-driven repayment plan request form. Don't let them do that. You select the plan that you want, and please don't miss the renewal deadline, whether you are in PAYE or REPAYE. We hope the information in this module will help you understand the differences between PAYE and REPAYE, and if you need an income-driven repayment plan, that the module will help you know which will be the best repayment plan for you. This is the end of module number 6. If you have questions about loans or financial aid, please contact Penn Student Financial Services. And if you have questions about general money management, please contact Financial Wellness at Penn.